Now on BBC World News, the latest business news from across the globe. World Business Report.
Taking a bite out of Apple. The iPhone maker's sales fall for the first time in 3 years as it suffers from China's COVID lockdowns and customers around the world cut back on spending. Opening up to the world. China's reopening means it will be responsible for a quarter of global economic growth this year. But the IMF also warns there are barriers to overcome. Hello and welcome to World Business Report. I'm Jonathan Josephs with all the latest on the global economy. Have the good times come to an end for the world's biggest tech companies? That's the question many investors are asking after disappointing financial results from Apple, Amazon and Google parent Alphabet. Their share prices are down sharply in pre-market trading after their latest results renewed concerns about the impact of higher interest rates on demands for their products and services. Specifically, Amazon reported its worst ever annual sales since it started selling shares on the stock market 25 years ago. The firm, founded by Jeff Bezos, lost $2.7 billion in 2022. Consumers have been cutting back on online shopping, giving the e-commerce giant the least profitable holiday period for years. From New York, Samira Hussain has more details.
Amazon shares plunged 50% in 2022. The company blamed higher costs because of inflation, the war in Ukraine, and supply chain disruptions. Now, adding to Amazon's woes, the spending habits of consumers who pulled back on non-essential purchases and really started shopping IRL. Now, Amazon had already warned Wall Street that revenue growth for this fourth quarter, for which it just reported, would be weaker than in years past. So what can we talk about going forward? Well, Amazon already announced more than 18,000 job cuts, and it still expects sales to increase in the next quarter, while still warning that the strong US dollar could actually temper its revenue growth. And while on the topic of earnings, Google's parent company Alphabet also reported. And as we've seen with tech companies that depend on advertising, with companies spending less, it means companies like Google, YouTube, and the other Alphabet products also took a hit.
Samira Hussain in New York there. Meanwhile, Apple shares fell after a disappointing last 3 months of 2022, partly because of consumers cutting back, but also because of COVID lockdowns at its factories in China. Supply chain disruptions have delayed global deliveries of iPhones over the holiday season, which is an important time of year for the company. Well, Ben Wood is chief analyst at the technology market researcher CCS Insight, and he joins us now. Ben, thanks for your time. What more is behind Apple's troubles? Is it as simple as the problems in China?
Well, I think it was really a combination of three things. So there were the supply issues that you mentioned. They get all of their phones predominantly from China, and the COVID lockdown there meant that their supply of products was very badly affected in November and also throughout all of December. But there were other things as well. The broader macroeconomic challenges that everybody faces and the strong dollar dragged Apple down. And I think that Apple will be very relieved that the supply issues now are behind it. It says it's got enough iPhones to fulfill demand. So let's see whether Q1 can bring them a bit of respite and make up some of those lost sales from the fourth quarter.
Well, you talk about respite, and China has lifted its COVID restrictions in large part, and the disruption that we saw at the biggest iPhone factory in the world has come to an end. So is it a question of now things can only get better, or will these concerns about the global economy and how much money customers have got in their pocket to splash out on the latest iPhone or other Apple products, is that going to be a big drag?
Well, I think that the reality is that no tech company is immune from the impacts of the macroeconomic situation. We know that people are struggling with the money in their pockets. But the quarter definitely showed that Apple's huge dependence on China to supply and manufacture its products are a real headache. And it's been a topic of conversation for years because Apple has invested so heavily in China to build that up. And the COVID lockdowns kind of exposed that risk. But they're in much better shape now as they come back on track. The question as well, though, is Are people buying phones as often as they used to? And the answer from our research is no. People are holding on to phones for longer. But Apple, out of all of the suppliers, are probably the best positioned.
And Ben, I noticed that Apple say they now have 2 billion actively installed devices. That means 2 billion devices that are working and using their services. Does that mean they are going to be able to increase the amount of money they are making from selling other things like TV services and music and taking cuts on financial products, that sort of stuff? And is that going to get them through the storm that they're encountering?
Absolutely. They came out with that headline, now over 2 billion Apple products in active use. Be careful not to mix products with people using them, because, of course, Apple are lucky enough to have multiple products being used by different people. So maybe that's somewhere between 1.3 and 1.5 billion people on the planet who are using one or more Apple devices. And I think that given consumer loyalty to Apple devices and consumers' propensity to buy other Apple products, whether it's a watch, headphones, MacBook, iPad or whatever, this has to be a positive sign. And I think that ecosystem is building some resilience for Apple. And of course, as you pointed out, the services business is there as well. They're investing in all sorts of areas, be it music, cloud storage, TV and others. But that's perhaps an eye to the future for them. And their services business has continued to grow. In fact, during the quarter, it grew about 6% to $20 billion.
Ben Wood from CCS Insights, thank you so much for your time.
Pleasure.
Now, China's economy, as we were talking about there, but it's expected to contribute to 1/4 of global growth this year. That's according to the International Monetary Fund. In its annual assessment of the world's second biggest economy, the organisation warned that the country still hasn't fully rebounded from the impact of COVID, and that it was essential that the government made the right policy choices in order to boost the economy. Well, let's get more on this with Duncan Wrigley, who is Chief China Economist at the economic consultancy Pantheon Macroeconomics. Thank you for joining us, Duncan. Now, the IMF is saying that China's economy is set to grow 5.2% this year. That would be the lowest in 30 years, apart from 2020, when the COVID lockdowns were really having an impact. What policies does the government need in order to increase that 5.2%?
Well, I think we're going to see some key policies coming out in probably March. So number one, the central bank is likely to cut benchmark lending rates to boost private sector credit demand. And number two, I think we'll see continued fiscal policy support, both in terms of investment projects. That's continuing. There's always a big infrastructure investment push already, but also policies to encourage consumption, such as, for example, electric vehicles, where China really is leading the way in the world.
And Duncan, there are some thoughts that China is still trying to navigate the balance between opening up from COVID restrictions and the impact that that has on health outcomes in the country. How important for the rest of the world is it that that balance is addressed correctly?
I think it is very important. Obviously, China, as you say, is expected to contribute a huge amount of global growth this year. If you look at how people in China are behaving, the psychology has already shifted. For the majority of people, they're already not talking about COVID anymore. You see people on the streets, it started on New Year's and Western New Year, but continued over Chinese New Year, people back in the cinemas, eating in restaurants. The vast majority of people have already caught COVID, and it's been a mild infection. And so the immunity levels for the population as a whole are up. And so I think the impact of secondary waves on the economy, at least, are going to be relatively subdued in the near future.
So with China getting back to work, as you say, is that hope for the rest of the world that it will increase the supply of the goods that we all want to buy, and that might help reduce inflation, which is obviously causing the cost of living crisis for millions of us around the world?
Absolutely. I mean, China has continued to invest heavily in manufacturing production throughout the whole pandemic. And because the global demand is weak, and that's leading to surplus supply in the production of many goods. And so you see, for example, the prices of chips are already falling. That's, it's its own sector. The electronics sector is quite weak. But also things like, for example, solar panels, the prices are falling. And so I think we'll see China serving, we've got a world which is just reeling from the effects of high inflation over the last year or two. China will act overall, I believe, as a disinflationary factor in the global economy this year.
Duncan from Pantheon Macroeconomics, thank you very much for your time. Now let's have a quick look at how global markets are doing, and you can see not a lot of movement here in Europe. Investors trying to weigh up the concerns from those interest rate raises that we had in Thursday from the European Central Bank and the Bank of England. There's plenty more on the website, bbc.com/business. Thank you for watching.